Greetings, friends. As always, I'm Oleh Ivchenko, head of the company Pareto. You're watching Pareto Point, a project where we regularly break down the most important topics in transfer pricing, CFCs, and the tax environment. This time, I'll talk about the latest report from the State Tax Service, foreign approaches to the valuation of options in transfer pricing, as well as the origins of modern transfer pricing rules. Ready? Then let's get started. The press service of the State Tax Service of Ukraine reports that in the first 7 months of 2025, large taxpayers transferred almost 585 billion hryvnias to the budget. This is half of all tax revenues in the country. But behind the facade of positive dynamics, there is turbulence in key industries. The mining industry, energy sector, manufacturing and trade all showed a decline, a decrease in tax payments ranging from 20 to 40%. The reasons: a tax on infrastructure, damage to logistics chains, and relocation of businesses. What does this indicate? When large companies falter, the fiscal pressure on the rest increases. We can assume that there will be a move towards increased inspections, especially regarding transfer pricing and profits. Therefore, businesses should prepare for them more thoroughly. An important signal has come from Europe. The Irish Tax Appeals Commission issued its first decision in a transfer pricing case, which concerned the inclusion of options in the cost of intra-group services. The tax authority insisted that the value of the options should be included in the cost of services. But the court sided with the business. The risks and costs associated with the options are borne by the parent company, not the local one. Why is this important? There is no consensus in global practice as to whether options should be included in the cost of intercompany services. This affects profitability, the tax base, and the approach to documentation. We should keep in mind that such decisions could set a new tone for Ukrainian cases as well. So keep an eye on the trends, and we'll help you with that. In August 2010, the Organization for Economic Cooperation and Development introduced an updated version of the OECD Transfer Pricing Guidelines, a document that has become a benchmark for everyone working with transfer pricing. 3 key sections were revised at once: pricing methods, approaches to comparability analysis, and the application of profit-based methods. A separate section on business reorganizations was also added. This was a major step toward harmonizing country practices and standardizing rules for multinational groups. And most importantly, it was a signal. Transfer pricing is coming out of the shadows and becoming a key tool of tax control. Tax authorities are seeking even greater transparency, and their requirements are becoming increasingly stringent. The focus is now not only on the result, but also on the logic behind the calculations. That is why now is the best time to review your documentation and your readiness for dialogue with the regulatory authorities. I, Oleh Ivchenko, and the Pareto team thank you for your attention. Leave your comments, subscribe, set reminders, and if you need support with transfer pricing, CFCs, or tax consulting, feel free to contact us. We will be happy to help. See you in the next episode of Pareto Point.